Guys, this is happening right now. I am seeing the lowest low season I've ever seen over the last 4 years. Occupancy's down, rates are down, a lot of markets are in a bad spot. And what we're seeing is that there's so much supply added over the last year to year and a half. We saw mutual funds and different kind of funds raising money to buy short-term rentals, companies that pop up that were private equity to go buy short-term rentals. These destination markets like Panama City Beach, where we're at, or Eastern Tennessee, or cities across the country that really propped up supply, chasing the higher returns of short-term rentals, which you can still absolutely get, but you've really got to consider as your supply and your demand changes, right? If you've got a certain amount of supply, and what we're seeing in a lot of markets is demand has continued to increase, but now supply is outpacing that, and that increases the competition of your listings, and it's hurting our own portfolio, which I'm going to show you guys here. So I want to talk to you about how, right now in the market, we're going not only into the low season, but into a down market with interest rates up. People are not buying as many homes. I saw an article this week that mortgages are down 21% year over year. A lot of underwriters, loan processors, things like that are beginning to lose jobs because there's just no demand on that side. So because your sales volume is lower, houses are sitting on the market, and it's creating, we're starting to see those market forces take effect with the Federal Reserve Chair pushing the interest rates up, and he's saying that they're going to push them up another 0.75 basis points, and essentially trying to create a recession after they created this up market with the stimulus and everything they did in the years prior, in the last year and a half, 2 years since COVID. But now we're in this critical time, low season, down market. Let's talk about what's happening and what you can do to prepare for it. And for those of you that don't know, my name is Blake Daly. I'm a real estate investor and short-term rental operator. Our business, Venture States, has 85 listings across California, Fort Walton Beach, Florida, Panama City Beach, Florida. Now we just got into the Ogden, Utah market. With these 85 listings, we have a very differing portfolio with a beach market and a mountain town. So very different forces, very different demographics, different seasonality. So I'm going to walk you through the differences in our portfolio and what we're seeing and how these market forces are playing out. But sharing all this to help you guys and hopefully to get you through this turbulent time. We've reached out to a lot of folks that own and operate their own short-term rentals, and they're seeing these same forces play out and are feeling that pressure of lowering rates, lowering occupancy. Obviously, they're netting less going into this low season, and it's more than ever before. So there's a lot of reason concern, but I'm going to tell you towards the end how you can actually take advantage of this, how you can prepare to turn this bad market, this down market, into an opportunity. All right, coming to the screen now because I really want you guys to see this. Now, I have never seen this much red on my listings ever before, and this is Pricelabs, and this gives you your listing health of your next 7 days, your next 30 days, your next 60 days. And I think right now we have 5 or 6 listings that have 0 bookings in the next 2 months, which is really concerning. And this is with, we have a sizable company, more or less, and we have a full-time revenue manager, and I've trained them. We've got ninja tricks in place, and this is just Pricelabs. So you don't see the discounts here. You just see the minimum set, but on our Airbnb calendar, you see these different discounts in here. These override Pricelabs because this is our biggest booking platform. I want Airbnb to get the most bookings. So we try to make those adjustments here and don't make all the same adjustments on booking.com or VRBO, because I want our bookings and our reviews to be centered on one platform as much as possible, outside of our direct booking platform, that kind of being the one exception. But this is what I wanted to show you guys. A lot of custom overrides down to the $40 per night, which is when you're doing revenue management, you want to really balance the having low rates, which attract like the bad tenants. At one point last year, we had our rates in the 40s, and we had, I'm pretty sure, who was a homeless guy staying there. Somebody booked the place for him. He, had one pair of clothes, didn't have a bag, didn't know when he was checking out. It was just a really bad situation. And then you get people with parties. So there's really a balance between lowering your rates to get occupied, and then also you want to know, like, what is your cost to rent that room. So ours is around, at this hotel, this is SF or Seafoam. This is in Panama City Beach, right across from the beach. And at this hotel, our kind of like break even for a place is like mid 30s to $40 per night. Can't remember off the top of my head. So anything over that is plus for us. So typically, set our minimums at like 60 to 55, but then use these overrides to try to get booked, to try to make something as we get closer. And you see, we got some bookings, but it's a very open calendar. Like I said, never seen this before. And this is in Panama City Beach. And then something else I want to highlight for you guys is it's not just the revenue. This is our company kind of data sheet here, but this is our what we call our scorecard, where we track all of our metrics. And the three I want to highlight is this average daily rate, occupancy, and RevPAR. And RevPAR, I think, is the most important metric there, because that's your ADR, your average daily rate, times your occupancy. So a lot of people think, oh, if you have 100% occupancy, you're doing the best. But I think that's misleading, because if you're leaving money on the table at 100%, right, you maybe could have made more money by being 95% booked, but by charging higher rates, right? If you were charging $100 a night and we're completely booked, but if you're 95% booked at $150 a night, obviously you're going to be making more money. So that's what RevPAR tells you. And RevPAR is your revenue per available room. Again, is your ADR times your occupancy. So that is the more important metric. So obviously a slow season has started. We've seen that come down, our RevPAR, right? This is our combined right here, AS weekly. And over time, like over the last couple of weeks, this has went down from 70 to 60, down to the 50s. So it's coming down as we've gotten to kind of the crux of the low season here. And then, like I was showing you before on Seafoam, even worse, over the last 4 weeks in October, we've had 64% occupancy, which is really low for us. But I will show here on our metrics, if I can get to it, on Airbnb, that across Panama City Beach, I've got Panama City applied here. For the month of October so far, we're at 73%. So we're above the market. So we're feeling this pressure, seeing very open days, and this has obviously gone down. You see here in the last week, it's gone way down, but we're above market and still feeling this pressure, because we do a lot of the pricing tricks that others in the market don't do. But I think the most illuminating point here is the supply issue. So I want to show you right here. And just in the last year, we go from June to June of 21, 10,100 listings, up to June of 2022, 14,100. So you're looking at a 30% increase in just a year's time frame. And that's listings that have come on market, creating more supply in the market. And then you have more competition, your listing versus John's listing or versus Brad listings, whoever it is. So the more comparable listings that there are to yours, the more downward pressure it's going to put on your price and your occupancy, and really your RevPAR. Like I was saying, you're going to net less money as that supply continues to grow. I mean, you can imagine to really make an example of this. Imagine if this doubled again, went to 30,000, then you had a ton of listings. People could be very choosy, and it becomes almost commoditized, where they're just looking for the cheapest rate, and whoever drops their rates down, and the competitors chase them down. And that's exactly what happens in the low season. You see all the people's rates, especially the ones that use dynamic pricing tools like we do, go way down. So when you have a lot more supply, you're fighting against other people. And as you get, more and more listings, there's going to tend to be some somewhat sophisticated people in their property management company, stuff like that, who actually use these systems. Not as good as us, I hope, though. So that's why I think, showing that we're above the average market occupancy, but still feeling these pressures in Panama City Beach is a big problem. And now I want to show you guys what it looks like in South Lake Tahoe, a very different market. I'll highlight our Pricelabs here for South Lake Tahoe. This is one of our lodges there. Very little red. You're seeing 70% booked for a month out, 77% booked out. I like to keep these around 33 to 40%, because I don't want to leave money on the table trying to maximize our RevPAR. That's one of our revenue management strategies, which I can get into in a later video. But this is a much healthier looking calendar. Obviously, this listing is not doing great. This listing is not doing great. But as a whole, the property in these 20 units
is doing much better comparatively than the property that I just showed in Panama City Beach. And I'll show that, like, this is, 64% right here over the last month. And then you look at property Moose and Maple Lodge, which is one of our really good ones over that same time period. You're looking at almost 80%, 79.84% occupancy, and then a much healthier RevPAR as well, because you got higher rates in that market, higher demand. We've also got some 2-bedroom, 2-bathroom units in that market that push it up. So looking here at the market rate, again, over the market, but we're still feeling it less so in Lake Tahoe, which really goes to show, as you build your portfolio, it's really good to diversify markets and have, different market forces and kind of flatten your revenue curve over the course of a year, like on an annual average, right? Because as we're at our lowest point of the year in Panama City Beach, around that December, January timeframe, I mean, it's colder, like the only point in Florida where it actually gets cold, down into the 50s maybe. I miss that because it's now snowed for the first time in Utah. But it actually is our slowest point of the year, but we really have a second high season in Lake Tahoe at that point in time, because we have, I think, 4 or 5 ski resorts. We're 2 blocks from Heavenly Ski Resort, which is a really good one. It's on the Epic Pass. If you're active military, go get that. So I think it's still like $169. But yeah, so you have very different market forces. So because we have like our second high season, it's almost as high as like, it's probably like 90% of June, July for those months of ski season. So you have a curve that goes up and down your shoulder season, which we're in the middle of right now, and highlighting kind of, this is so prevalent because it's the middle of the low season heading into this down market. So I'm really hoping for some snow in Tahoe, so we start getting some skiers up there.
All right, so I showed you guys our market data, and I hope I didn't go too fast. I'm gonna talk this over every day, every week with our team, so I just kind of flow through the information and the different metrics. So go back and watch that stuff, or throw comments below, or questions, and I'll try to get to those as I can. But what we're seeing in really both markets, and I'll highlight it in Panama City Beach and kind of talk about the nuance of the Tahoe market. But in Panama City Beach, supply has gone way up, which has put downward pressure on price and occupancy. So it's a bad time, especially going into low season. Then the nuance for the South Lake Tahoe market is that they had something called Measure T that went into full effect in December of 2021, and that eliminated a vast majority of the residential short-term rental listings that you could have. Now you have to get it on a permit, and they limit that number of permits. I think you can only do it if you live in the house now. Like, there's very weird rules, but because we have these boutique hotels that are zoned commercial, that didn't affect us. So that actually lowered the supply in that market. And we're seeing it start to come up now as some of these other hotels and motels get their listings on Airbnb and stuff like that. But it's, at a much slower pace compared to something like Panama City Beach, where you have institutional money purchasing up these houses, building new developments, turning them into short-term rentals, more investors buying them, and supply moves a lot faster there. So it highlights the importance of like really knowing your market and trying to get diversified if you can. But now is the part that I'm looking forward to, is how you can actually take advantage of this. One, like I said, is diversification. Like, definitely try to get, exposure to different markets. I always think, like, look in your backyard first, really learn and get to know your first market and become really good there before you try to, start buying in Tampa and then buying in, California. Like, don't spread yourself out like that. I can say from experience, it's very hard. But you can do it if you want to, but I would not suggest it. And 2 is this is now the time to really start looking on the purchase side. With rates rising, you're kind of seeing prices maybe go a little bit slower, but really kind of flatten out, or even some price cuts. I was just looking today on the residential side and seeing a ton of price cuts, 60,000, 100,000, 90,000, a ton of money coming off the table that could be equity in your pocket. And I think, all things equal, you'd rather have the higher interest rate and the lower purchase price, because that's going to give you more equity. And if you can never change your basis once you purchase the property. So if you purchase at that lower price, it gives you exit options down the road, and you can always refinance that property when rates come down, right? So if you buy at a lower interest rate and a higher price, like over the last few years, you might be in hot water because you might have, if the market comes down a little bit, you might have negative equity into, to do anything to refinance, you're going to have a higher rate. You can't sell it because rates have gone up. So by having that higher basis with a higher purchase price, you're really in a bad spot. But now, as we see those coming down, you have a really good chance to, start to put in more offers. Put that price that makes you blush a little bit, because you don't want to be the one buying a bad deal right now. And sellers are going to start getting a little more needy, right? If the longer their property sits on the market, the more antsy they're going to get. And I know, because I've known those people and I've been those people before, selling different properties and also buying. And then it also gives you the chance to put some creative things in your offer, like seller paid closing costs, point buy downs, whatever that is, trying to get more to, you can spend less out of pocket to have a better deal and a higher return on investment. So right now, what we're doing to try to take advantage of this market is really build our funnel, right? We're going to put in as many leads as we can. We're going to analyze them. We're going to put in our offers, and hopefully the point of that is the more we screen, the more we analyze, the more we offer on, the more we'll have at the end, and we'll have properties to get under contract and hopefully close them and add them to the portfolio. So that's a big focus of ours right now, is being very intent, being very analytical, and really looking at opportunities right now. Because, yes, high interest rates are bad, but if we can get better deals because of it, I'm fine with holding on, to a 7% rate for 12, 18, 24 months if I get a good purchase price today, because then I can refinance later on, maybe pull out some equity and get a boost on my cash flow by lowering that rate. So all that to say, I think right now it's kind of this turbulent time, right? You might be waiting to see what happens. And I don't think waiting is a bad thing, but I think it's always a good time to take action when you're being smart about how you're analyzing your properties. Are you holding your own cash reserves? We're holding about 3 months or so right now, and building that as we go along, just, hoarding that cash flow to make sure we're in a good position to, weather a storm, put the down payment or the lease payment on the next property, so we continue to grow and scale, and hopefully do that more out of our own pocket. And then also, right now is a great time to be networking, finding other people, trying to build your capital stack, trying to make connections, trying to get into different things. When other people are taking a rest and, waiting it out, it's going to be more opportunity for you getting out there and taking the action. So yes, we're going into that down market. Yes, we're in slow season. Yes, rates are going down, but pretty optimistic about where we're heading into. And now I just got to jump back into our revenue management and make sure we're getting our place booked, maybe do some more ninja pricing strategies. So I hope this video was helpful for you, learn something, put your questions down in the comments, and please like the video. That helps, get the reach out there, helps get other people this information. And if you liked it, please subscribe. I'd love to see you back for the next video. See you guys next time.